You think, well, the Fed's on the sidelines clearly now. It's going to be an earnings story, and that's not going to pick up till the back half.
That's right. And I think the markets, as a result, are going to have a tough time in the second half of 2019 making any meaningful headway. You think about the 17% appreciation that we've seen year to date. I think that's largely been driven by central bank policy, the shift back to dovish or easing conditions. But the question becomes what's next? And with near flat earnings growth this quarter and probably next quarter, I don't think that's good enough for markets. We've got valuations that are rich from historical perspectives. And we've got some cracks in the earnings cycle where we're seeing profit margins coming under pressure. And the number of companies that have missed their earnings is actually on the increase. It's higher than it was in the third and fourth quarters of 2018. So all that at a time when earnings growth is basically slowed to a halt, I think it means that markets are going to be at risk for at least a pullback in the second half of this year.
Powell made very clear that there was no impetus to move rates either way, up or down. If he had opened the door to a 25 basis point cut in December, which is what the markets had anticipated, would your view of the markets be a little bit more constructive?
Well, certainly that would help valuations because it means that your interest rates would go lower. And so when you're valuing companies, it comes down to profits and interest rates. But the Fed might actually begin easing by default. And that is because, number one, as they end their balance sheet reduction, they're going to have all these bonds maturing on a monthly basis. I think they'll reinvest those in the short end of the curve. And then secondly, as they begin to talk more about this idea of inflation targeting, I think it pushes the 10-year Treasury yield up higher. And that will end up being pretty good for equity markets. But I think in the short term, it's going to be this tug of war between really dovish central bank policy, but an earnings problem.
You're shifting lower on U.S. equities right now. Why?
Yeah, we wouldn't say U.S. equities are overvalued or richly valued. We'd say they're full to fairly valued. Then that's come from being undervalued at the start of the year back to kind of a long-term average. We would agree that you need to see something now drive equity higher, and we're not going to rely on valuations. If the Fed did cut, that would raise valuations, but we don't see the impetus for that. We don't think the Fed has to. They're going to be on hold for a significant period of time. So we think the volatility is more a second quarter thing, and you start getting some positive impetus in the second half of the year when the stimulus overseas, both accommodative monetary policy, but also pretty significant stimulus by Chinese policymakers, start to play into the global system, and that can be the next leg higher. In the meantime, we'd rather go overseas where we can see better valuations and some short-term catalysts for earnings growth before we see it in the United States.
So do you go China or do you go a derivative of China, and that would be Europe?
You know, we're doing direct investing in China. We still see opportunity onshore.
When you say
China,
direct investing in companies, directly into
A-shares, into the A-shares and
A-shares.
into Greater China.
Okay.
You know, Chinese equity markets, the A-share market sold off 25% last year. You have seen a 15 to 20% bounce this year, but it's still below long-term fair value. And it's going to take 6 to 9 months for the stimulus really to kick in China. You're starting to see some positive news, but for every good headline, you get a negative headline. And we think we're going to get solid evidence of that story in the second half of the year, and then you'll benefit from that next leg higher in Chinese stocks.
How do you position, Joe, for earnings that will come back later in the year?
It's a good question. So I think we will see volatility. I think the good news is it's not the end of the bull market because we have an economic cycle that I think is going to go on for a lot longer than most people think, which means we'll have an opportunity to see corporate profits recover. So in an average calendar year, the market's going to fall about 13%. So who knows if we're going to get that correction or not, but the data tells you it seems likely. So if we do get that type of volatility or even a pause, I think the way to position is cyclicals. Energy, industrials, materials, discretionary, and even technology, because these are the most globally exposed. They're the highest beta, so they have the highest exposure to sort of the underlying economic environment. So I think if we do get that shorter term weakness, I would buy into those more cyclical sectors. I think they're still sort of more attractively valued than defensive sectors. So I think that would be the play. But the bottom line is, even if we do pause in equity markets for the second half of 2019, it's not the end of the bull market because I think the economic runway is still a lot longer than people think. So I think we will have an opportunity to see profits recover.
It's not the end of the bull market, but in terms of the risk reward to the upside or to the downside, is there more risk to the downside at that point?
Well, we've got to grow into valuations at this point because, what we're seeing is revenues are roughly still growing at about the same level as 2018, but profits are coming down. It tells you that companies are having problems dealing with higher wages. They're having other sort of problems that are causing the sort of margins to roll over and EPS growth to slow. So I think we will need some time to work it out, but the underlying economic environment is going to be healthy. It will be good for corporations over the long term. So I think we just need to grow into a market that's trading at about 17.5 times forward earnings versus a historic average of about 15.5.
CNBC has reported that perhaps there will be a China trade deal as early as next Friday. Should that be the case, Erik? Does that change your view on U.S. equities at all?
I think that's largely priced into the U.S. equity market. I think China gets a little bit of a pop because it has kind of retraced over the last month or so. I would say that the other way to bolster your risky assets position is because we don't want to be, adding equity exposure in the U.S. in the short term, but there are a lot of opportunities with the Fed basically on hold for the foreseeable future just to add carry in a portfolio. And we're seeing, that as a really interesting opportunity when there's not as much upside with equity risk as has been pointed out in the short term. So adding exposure in EMD debt where you can pick up 6 to 6.25% yield, pick up some exposure to some undervalued currencies, even shifting from high yield into bank loans, which is a bit of a contrarian move right now. Get 5-6% in yield in an environment where equities are fully valued. That's a nice way to pick up some income to be able to invest once we get some additional volatility.
But even within a full U.S. allocation, what does that consist of sector-wise? It's more interesting when we disagree, but I agree. We're pivoting, aside from in the short term trying to be positioned for volatility. So we're actually selling puts on the S&P 500 to capture, kind of attractive premium and protect some of the downside. We are shifting towards cyclicals. We think that's the next leg higher as this cycle extends. So cautious, but let's be in cyclicals.
Well, we want to take advantage of what we do expect to be short-term volatility to add to exposures. We haven't seen as much volatility as we'd expect this year. It's been straight up.
Yeah.